And our last presenter is Tony Cookson from University of Colorado Boulder. And I'm sorry, he's going to talk about social media as a bank run catalyst.
All right, thanks. Thanks to the organizers for including the paper, and thank you all for your attention. This paper is joint work with Corbin, Javier, Juan, and Christoph, and I'm Tony. So the motivation for this paper, kind of from where we're coming from, is the sort of unsettling idea that a bank run can be a self-fulfilling prophecy. On one hand, there's a good equilibrium where depositors have a low belief in running, and that supports a low likelihood of seeing a bank run. But that coexists with a bad equilibrium in which depositors have a high belief in running, of other depositors running. And in that equilibrium, that supports a much greater likelihood of seeing a bank run. This kind of leads into a discussion of, well, why and when do depositors end up in this bad equilibrium? And this has been kind of a theme in the literature for quite some time, where people have pointed to sunspots, communication versus via word of mouth, and other social propagation mechanisms, sort of telling people who you know about kind of what your intentions are. Our question, motivated by this year's events, was to ask, well, does exposure to social media as a communication and coordination technology raise the risk of bank runs? And this question didn't come necessarily out of nowhere. The Silicon Valley Bank failure was something that motivated us to look into this. People sort of almost immediately linked social media to this event. People in positions of power in this country did so. And even in the next week, after the Silicon Valley Bank had failed, headlines were speculating that this was a social media fueled bank run. Our interest isn't necessarily just in SVB. Our question is, did social media exposure matter for other banks? And so what we did is we collected systematic data about all of the tweets authored by people about publicly traded banks in the United States. So we collected all of the tweets back to the beginning of 2020, and where it mentioned the ticker of the bank, something called a cash tag. We then take this empirical strategy where what we do is we identify a period that's before all that turmoil. We call it a pre-run period. The tweets, the stocks, the bank stocks that were in a social media discussion, we will classify as being pre-exposed to Twitter. And then we look during this sort of SVB run period at, well, what happens to the stock prices of those banks during that period. The stock prices, the bank stock returns during this period, those are our outcome of interest, mostly because my conversation with the payment processor didn't work out to get me high-frequency depositor outflows, but we think that it is informative of the type of risks that these banks were facing. We complement this with a menagerie of complementary tests where we zoom in at the hourly frequency and the 10-minute frequency around tweets that were authored about these banking securities. And it all kind of tells a pretty consistent story that higher exposure to discussions on social media is related to deeper declines during this SVB run period. And it's not driven by SVB, but by other banks that were in a Twitter conversation. So our main result is that for banks that were in the top tercile volume of discussion, we can predict about 6.6 percentage points greater loss in their stock price or stock valuation. By comparison, if you run the same kind of regression but with the percentage of uninsured deposits, you get a pretty similar magnitude of about 4.1 percentage points. More importantly, we think, is that if you consider the interaction between social media and these more classical risks that banks face, like having a lot of uninsured deposits, the interaction is what matters quite a lot. So what we find is that it's even greater declines for banks that have high uninsured deposits if they're in a social media conversation. We did all of the initial analysis using Twitter pre-exposure and looking at stock prices. We had written the paper, and then later Q1 data came out, and we conducted kind of a similar analysis looking at what happens to outflows of uninsured deposits. And this seems at least reasonably consistent with the message that we're seeing, but not quite the same timing that we're seeing with the stock returns. We do a lot of contextual analysis in the paper. We look at like what kind of keywords dominate the conversation, and people are mentioning running, contagion. They are certainly pointing to the types of risks and fears that I think we had the sense that was happening. The tweets started with investors, so sort of a happy from the standpoint of research accident, is that SVB's ticker is SIVB. And so what we saw was actually the conversation spiked in SIVB before a broader conversation about SVB, which depositors and other members of the community would use to refer to Silicon Valley Bank. We see high frequency effects on returns, not just driven by SIVB. And kind of really importantly from like a depositor mechanism, we see a conversation among likely depositors in SVB who were members of the tech community. We can identify that using their Twitter bios. You can see if they mention VC or startup. They're likely depositors. When they tweet, they're really big movements in the bank stock prices. So a little bit about where we think this fits. New technologies have been linked to banking stability. We think social media is a communication technology that complements sort of those other technologies. We also think there's something distinctive about social media that's not just social networks. Social media is a place where anyone can author something that can go viral, which is distinctive of other technologies like newspapers, where a journalist might have to author it. That kind of reach for an everyday person who could be a depositor is pretty distinctive of this technology. And in coordinating equilibrium, it sort of raises some concerns that are distinctive to an era of social media. So let me tell you a little bit more about sort of how we go about this. So I'll give you some perspective on the data, some contextual evidence, and I'll show you some figures that encapsulate our main results. So we collect, as I mentioned, all of the data on tweets about the bank stocks. That's 5.4 million cash tag tweets. We also supplement this with broader discussion keywords. We link with stock data and banking data, and consistent with some of the things we were discussing earlier, we measure sort of the mark-to-market asset decline, consistent with sort of a recent paper in the literature, as well as the percentage of uninsured deposits, thinking of those as both types of risk factors that could be related to what sort of drives the run in the run period. So contextual evidence, we have two pieces of this. One is just what words are people using. We build a dictionary of run terms, so words like get out, take money out, cash out, and then we kind of iteratively sort of populate that with like other words that coexist with like get out. And same thing with contagion, and we did some other things about like discussing balance sheet terms as well. But the ones that seem to be pretty important were run and contagion. These mentions were really rare pre-run, but not after March 8th, as you can imagine. Next, we also supplement with some analysis of retweets. There were some prescient tweets about SVB that were authored in January, but those were incredibly rare. And the other thing about them is we can actually see the timing of when all of those were retweeted. They weren't retweeted much until the bank run was already underway. And so most of the communication, the vast majority of that communication was during that bank run period. It was not kind of a swell of communication and information that led to this. There was a kind of an event. That event led to this discussion, and this discussion had a lot of concerning terms, starting with investors, and then by actually identifiable depositors in the SVB. Let me just go ahead and sort of show you a little bit about this. When we sort on the run and run dictionary for how many tweets were loaded on our run dictionary, you might worry about like, how do we pick those words? It looks like it actually identifies the banks that experienced runs. Coexist with contagion. And the other thing that's kind of important from our standpoint is also coexist with them being in the conversation pre-run. We think that is sort of almost a necessary condition to have this kind of broad, kind of wildfire-like conversation. Here's kind of another picture of it. That pre-run period has a lot of different terms that don't have a whole lot to do with running. The run period dominated by Silicon Valley Bank, and if you kind of zoom in, you'll see the run and contagion terms that were associated with that as well. Okay, so let me just show you the cross-sectional test as a reminder. We're using pre-exposure during this period where people weren't mentioning much about running. And we're just looking at are you in the sort of the top tercile versus the other terciles of are you in the conversation versus out of it. Just being in the conversation, that leads to that's associated with a decline of about 6.6%. And then when we consider the interaction between being in the conversation and uninsured deposits, it's a higher decline, more like 8%. If we consider that triple interaction of having lots of mark-to-market losses, high uninsured deposits, and being in the conversation before the run period, that really is associated with very steep declines in the stock market value. We can also see if you sort of look at just the uninsured coefficient, if you are in low Twitter pre-exposure versus high Twitter pre-exposure, uninsured deposits don't really matter as much for predicting stock price declines in the low Twitter pre-exposure. So we think that's a pretty striking result. Let me tell you just a little bit about some of the high frequency evidence. Some of this is contextual. So here's that result on the conversation starting with the investors and spilling over into a broader class of discussions. SIVB, as you can see, sort of spiked in the morning, and that's about 3 hours before the spike that you see in the conversation about SVB. We think it's a reasonable proxy that people are talking about SIVB, that they are kind of more attuned to kind of the investment characteristics, whereas SVB is kind of more the term that anyone might use, potentially depositors. So we think that that's kind of an interesting piece of contextual evidence. It sort of points to there being like a spillover in this conversation from investors to kind of a more depositor concern. Another way to get at this is we classified the discussion among VC connected or tech users who are likely depositors. You see is actually that's pretty, that whole discussion is delayed relative to that initial spike. And it's dominated more by SVB keywords. So we think that also sort of points to this being sort of depositors talking about their intentions out in public. Here's kind of a picture of what the stock price does when you're in the top tercile of the conversation versus the bottom two. It doesn't so much matter if we include SIVB in our sample. The top tercile at high frequency, you see much steeper declines in the stock market prices. And this is for the banks that are all run exposed, so they all have those other risk factors. We also look at the tweet level. Main thing here is that we see that negative sentiment tweets have an impact, but positive sentiment tweets don't. And that the tweets that mention contagion and the tweets by the tech community have much more immediate impact than tweets authored by others. So overall, what do we learn from this? We think that we learned that Twitter communication and coordination have an imprint beyond SVB. Main message is the existing risks are greater when they're in the presence of social media. And what's distinctive about social media is its virality and its speed. I think those both pose challenges for sort of how we think about these things. So thanks for your attention. Looking forward to the conversation.
Thank you so much, Tony.